the silver lining of a slowdown in the M&A market is that buyers are getting much better rep and warranty insurance policies. So from a risk allocation perspective, you're getting cheaper, better, and policies that historically were not covered by the market. So from a cost perspective, we're basically back to pre-pandemic premiums. So if you compare it to the 2021 peak, you were looking at premiums in the US around 6, even 7%. We're now around 3% in the US, even cheaper. In Europe, you're around 2, it could even be cheaper, and in Latin America, 4%. So much cheaper policies than what we were seeing 2 years ago, for sure. So in addition to cheaper policies, you now get better coverage, so better policies. For example, since COVID, it's been basically customary to have a blanket COVID exclusion. As the risk related to that pandemic go away, so have these exclusions. From a coverage perspective, you're also seeing a lot of industry-related exclusions gone away. So historically, it was really hard to get coverage for highly regulated industries such as healthcare or financial industries fields. The market is getting smarter and have been able to price the risk a lot better, so you're seeing those exclusions go away. Many years ago, a lot of carriers would exclude calculation of damages based on a multiple. Now, given the market, you're hardly seeing any caps, and typically these policies are now silent with respect to calculation of damages based on a multiple. The last couple of years, you would typically have an exclusion on cybersecurity, or coverage would be on top of an underlying cybersecurity policy. As the market shifts and there's more competition, you see some carriers being aggressive and covering cybersecurity regardless of whether there's an underlying policy. So historically, a lot of the rep and warranty insurance carriers would stay away from certain types of deals. In this market, you see carriers covering different types of transactions. For example, for smaller deals, these policies were hard to cover because there was always a minimum premium that didn't make economic sense to get coverage for your smaller transactions. Now, you have a lot of carriers being very aggressive and offering very small premiums for smaller deals. In fact, some carriers are offering synthetic policies that are covering, regardless of the reps under the purchase agreement, they're covering synthetic reps in exchange for a very small premium, say $50,000, so that now you could get protection for even very small deals. Historically, it was hard to get coverage for minority investments or growth equity deals. The market here has also adapted and shifted and are now covering growth equity transactions. A couple of years ago, it was really hard to get coverage for M&A transactions where the target was in jurisdictions outside of Europe or the US. For example, Latin America was really expensive and really hard to get coverage that made sense. It was subject to a lot of exclusions. Now the market has shifted where you see policies that are now more market terms that look a lot more like either US or European policies. One of the staples of rep and warranty insurance policies is that they don't cover known issues. Now, because of the market, a lot of carriers are offering other products that would, in exchange for a premium, cover contingent liabilities or known issues that you identified during due diligence. So unless the market turns around for Q4 of this year, which there's no signs that it will, we expect that both the price, the terms, and the types of deals that rep and warranty insurance carriers are covering will remain the same.